Happy Thursday. Stocks log a decline after yesterday. We broke 3 straight days of declines. It's 30 minutes to go until the start of your cash trade. I'm Dani Burger. Bloomberg Open Interest starts right now. On today's show, Walmart's earnings disappoint, sending a warning signal across the retail sector. The 30-year rally unravels as Bessent's bid to tame yields faces a skeptical market. And President Trump threatens Iran with economic warfare after failing to reach a deal. Some of the big earnings that we got this morning, I mentioned Walmart. We'll talk with Nora about this in just a moment, but shares are down 6.75%. They fell short of expectations. There was a sales miss. Comparable sales rose only 2.6% in the last quarter. That's the slowest in over 6 years. Over in the world of tech, sources telling Bloomberg that Meta has now become one of Microsoft's biggest AI customers. It's spending hundreds of millions of dollars a year to access AI through the Azure cloud services. We'll get into that story in a bit as well. But first, let's start with the Walmart earnings and the disappointing share slide we have seen. Bloomberg's Nora Melinda joins us now. Nora, what went wrong for Walmart?
Well, when you think about Walmart, this actually gives you a great read on the consumer, and they called it a few things. Of course, this was the first rare sales miss that we've seen from the company in a while, but also a drag on Walmart was the pharmacy space. Now, we weren't essentially seeing a lack of volume for transactions in their pharmacy department, but essentially it was all due to the federal drug price negotiations actually making drug prices lower. And so, of course, as you can imagine, that's actually going to weigh on Walmart. But we did still, of course, see tariff refunds in focus. We're also seeing shoppers that were avoiding some of the grocery store section based on a lot of those foodborne illnesses that we've been talking so much about as of late. So there's a lot of different areas that Walmart's essentially been grappling with. And when we think about this in light of the other retail earnings that we've been getting, it really gives you a great read on the U.S. consumer in this moment.
I say a messy quarter. How much of it, though, was not just the consumer, but particularly a lower-end consumer that keeps facing inflationary pressures?
See, that's the thing. So it wasn't essentially a consumer that was hitting the emergency brakes, right? But they're essentially being more selective. They're doing certain trade-offs. They're saying, hey, maybe I'm not going to get this most expensive thing. I'll just get a small thing here and there. So it does show you that consumers are being quite selective and very choosy with where they're putting the money that is coming in to their wallet, where they are interested in deploying that, and where they're actually holding back.
Nora, thank you very much for joining. We'll catch up with you later in the hour. That's Bloomberg's Nora Melinda. And we're going to get more on Walmart also later this hour. Evercore ISI Senior Managing Director Greg Melich will be joining us around 9:40 a.m. Elsewhere, Meta has quietly become one of Microsoft's biggest AI customers, spending hundreds of millions of dollars a year to access AI models from Microsoft's Azure cloud services. Bloomberg's Neil Campling joins us now on this story. So getting a view into Microsoft's business, talk to me about that relationship between the two companies.
Yeah, so it's a interesting setup here. I mean, partly what it tells you, Meta have said before that they cannot get access to enough compute. So in some sense, it makes sense perhaps that they are getting the compute power from Microsoft. But we haven't really got any AI services out of Meta yet. So that raises one question. What might be happening here, which hasn't yet been discussed, is that actually perhaps Meta are arbitraging the costs of AI. So they said before that they had offers for substantial prices above what they're paying for compute from third parties on their platform. So maybe what they're doing is arbing out the fact that token costs have come down significantly so they can rent them cheap from the likes of Microsoft and then sell services themselves, AI compute from their platform, much higher prices to other people. So that could be going on.
Meta has been making various moves, replacing some of the technology used from Microsoft previously with in-house, building its own business to sell access to various AI models. Does all that suggest, Neil, that this is just a snapshot of a moment in time and Meta ultimately does want to move away from Microsoft?
I think the ultimate end goal would be to try and move away from Microsoft for sure, because these partnerships work for short term, but you want to have your own AI frontier model effectively. There's not enough room in the world probably for Anthropic, OpenAI, Microsoft, Meta, Amazon and Google all to be the significant winners in this particular race. So it makes sense that they want to have their own platform, but how this shakes out remains to be seen.
Hey, Neil, thank you very much for joining us. That's Bloomberg's Neil Campling. The Treasury rally, sparked by Scott Bessent's surprise intervention, is now fading. San Francisco Fed President Mary Daly weighed in on what the Fed can do during this time.
There's a lot of discussion about our credibility. There, I don't see our credibility at risk. I also hear a lot about should we be making preemptive cuts or hikes, rather, and I don't see a lot of evidence that that's an urgent problem to solve. I'm looking at inflation compensation and inflation expectations, and you don't see any worrisome swings in those pieces of data either. So I think policy's in a good place.
For more, we're joined by Bloomberg intelligence rate strategist Ira Jersey. Ira, you and I were having this conversation around the same time yesterday, and you were saying, look, this is likely short term because of these long-term structural issues. Did you expect it to be so short term that treasuries essentially have mostly erased their gains of yesterday?
Yeah, I mean, it was the knee-jerk reaction yesterday that I thought would fade a little bit. And when we talk about the size of these buybacks, they're not particularly big in the grand scheme of things. Now, they do affect a little bit some liquidity in that it takes out a lot of long duration or some long duration debt off of, say, dealer balance sheets. But affecting liquidity doesn't necessarily affect the level of yields or the longer term trading. That's going to be driven by fundamentals and also supply demand imbalances that can be affected by what's going on in the global rate market.
One thing that hasn't changed course of direction, and that is the dollar. It's barely changed this morning, but still slightly weaker. Ira, a conversation also seems to be building that what the Treasury is essentially doing is trying to keep yields in check at the sake of the dollar, and something that could lead to inflationary pressure, a commodity super cycle, and kind of lead an inflation-driven commodity cycle, rather, not a super cycle, and lead to this kind of dangerous feedback loop. To what degree is a weakening dollar after yesterday's move a concern for this market?
Well, I think it's been a concern at least since the beginning of the war, right? And one of the issues has been, will there be a shift in capital flows out of the U.S. or if not out of the U.S., then maybe slower flows into the U.S. And other jurisdictions will benefit. So I think even yesterday when we chatted, we talked about the Japanese yen. And if you hedge the Japanese yen back into certain currencies, it actually yields more than U.S. Treasuries. And so that makes it more appealing for a certain group of investors. So you're not necessarily seeing a lot of selling, but you're just seeing, I think, a bit of a buyer strike. And the thing is, when you have a buyer strike like this, it's going to be hard for the market to rally very significantly unless something changes either fundamentally in the U.S. or you wind up having a reason, like some kind of structural reason, for people to be buying U.S. debt. Now, there is, right, that we still have very large insurance companies and other types of flows. And you did see that yesterday. Like, I was talking to an investor in Asia last night, and they did say, hey, we saw a lot of flows into the long end, both of the U.S. and Japan last night from Asian life insurance companies. So it did have some psychological effect. But as you mentioned, it's not going to last very long because nothing's changed fundamentally.
Well, one of the structural issues that at least Barclays has been pointing to over the last 24 hours is just the place where demand is coming from for treasuries has changed, that the Fed has backed off along with other foreign official buyers. And instead, what's taken their place is private buyers. They say the statistic, private buyers like mutual funds, foreign investors, banks, households, they used to hold 50% of treasuries a decade ago. Now they hold 73% of treasuries. Does having a more price-sensitive buyer, does that lead to the kind of boycott or the pause that we have seen on buying treasuries as yields drift higher?
Yeah, it does, and that's been a longer-term trend, right? So since the Federal Reserve stopped buying bonds during the QE program a couple of years ago, you have seen these more price-sensitive buyers become larger and larger market participants. Now, some of them have to. Like, keep in mind, like, if you're an insurance company and you have U.S. dollar liabilities, say because there's shipping offshore or something like that, you have to own some type of U.S. dollar asset. So the question is, what's the one that you want? Do you want to own corporate debt? Do you want to own treasuries or something else? So there still are some captive buyers, so just not as many of them. And like you mentioned, they are price sensitive. So they're going to say, like, look, if we think that debt to GDP is going to continue to rise in the United States and it's going to become a problem at some point, why do we want to own 30-year debt? Maybe we'll own 5-year debt or 10-year debt, but we're not going to buy out that far on the curve. And it's clear that we're at a point where there's not enough liability-driven investors in the long end to keep up with the supply that the Treasury Department keeps selling to us. And another $4 billion a month takedown is not going to really affect that supply-demand profile because there's just so much of that debt outstanding.
Ira, really great to catch up with you again this morning. Ira Jersey of Bloomberg Intelligence. Let's get a check on your markets. 20 minutes to play for until your cash trade begins, and we are down 0.4%. We did have a broad-based rally yesterday, largely led by that move in treasuries, although tech did fall. So tech falls now for another consecutive day, down 0.5%. Yields popping higher, 5 basis points. We are only 2 basis points away from being at the exact level we were before the Treasury's announcement yesterday morning. Brent crude also not helping, up 2%. Coming up, President Trump calling for economic warfare against Iran. More on his latest threat. That's coming up next. This is Bloomberg. Let's get you some high interest stories. A look at what's making headlines around the world. The U.S. national debt has topped $40 trillion for the first time, more than doubling over the last decade. And the hole is expected to get even deeper, with interest costs now representing the third largest part of the budget. AI is taking center stage at the Fed. July meeting minutes reference AI tech 18 times as officials debated whether the investment boom could fuel inflation, reshape employment, and create financial stability risks. Policymakers also warned that disappointment over AI's productivity promise could hit consumer spending and lenders. President Trump says the U.S. is now waging economic warfare against Iran, threatening to isolate Tehran and countries that help it trade. The warning puts China, Iran's biggest oil buyer, in focus. Beijing says sanctions won't resolve the conflict, while Iran is accusing Washington of economic terrorism. For more on Iran, we are joined by Bloomberg chief political correspondent and co-host of Bloomberg Surveillance, Anne-Marie Horduran. Anne-Marie, what does economic warfare mean in this context?
Well, we've had economic warfare in terms of the United States on Iran for years, especially this administration has at points have had maximum pressure. They've also, in the midst of this conflict, also gave a huge lifeline to Iran. If you remember in June, when they actually lifted some of those sanctions and Iran for a short period of time was able to sell on the global market, they thought maybe they were coming in closer to a deal. So right now, the United States really has a ton of sanctions on the regime. The issue is, of course, is that Iran is able to still get oil out to one of their biggest trading partners, and that is China. And China buys the lion's share of Iranian crude, any crude that's able to get through that U.S. blockade, which the blockade has been working. And there is a pretty aggressive U.S. posture there. So this would mean the United States having to go after those networks, these other trading partners. And this creates a very awkward dynamic for the administration, given the fact that Xi Jinping is coming to meet with the president in September. And if they were to carry through on this, potentially what would then be China's reaction? Maybe going after things again like the United States and making it harder to get rare earths and those licenses. At the same time, if the United States was to double down and have more economic pressure on some of the entities Iran does business with, would we see higher crude prices? And that's also going to be a problem ahead of midterm elections.
So it seems like they don't have a lot of options here. What about pressuring other countries to do what the UAE has done, for example, and them cutting off economic ties? Could the Trump administration talk to their partners in the Gulf and try to have them exert pressure?
Well, I think the president has indirectly sort of done that, say, with the Omanis, saying you need to make sure that you are prioritizing your relationship with the United States.
Directly and saying, well, Obama, you, yes. You do it.
Yes, but basically saying you need to prioritize your relationship with the United States and not the regime. But if you've ever been off the Gulf, the coast of Oman, you literally see the coast of Iran. These are very close neighbors to the Omanis, which is why they've been trying to do this deal with Iran to reopen up the Strait of Hormuz, but they definitely play both sides.
In the meantime, there are still issues closer to home that the president is dealing with. We're in the midst of this 3-day pause with Canada, and the reporting has suggested that they are lowering some of the tariffs or looking at them on things like auto and other metals. Where do we stand sort of in this relationship, in this standoff between the U.S. and Canada?
So it was like 11th hour tweet, basically. the president said, before midnight, I'm not going to go through with these tariffs, which basically, is taking some pressure off the relationship. The trade teams are working together, so maybe things like steel, aluminum, autos, you can see those tariff rates drop. This is a bigger story for the USMCA negotiations, and I just spoke with a source about how basically this brings Canada back into the fold when it comes to those conversations, because Canada has sort of been out there in terms of a very wide gap between the president and Prime Minister Mark Carney. Mexico has been having a lot of these chats with the United States. How are they going to renegotiate USMCA? And I think this could be a critical step towards that.
How much of this is factoring into what we're hearing from midterm primaries now, but just general races and what candidates are talking about?
Well, candidates continuously talk about affordability. The president himself ran on affordability, but if you see after survey, Americans still aren't feeling it. We have been dealing with in this economy a continuation, a snowball effect of shocks that continuously mean more price pressures. And that is why, if you look at some recent polling, the president is suffering some serious numbers when it comes to the war in Iran. I think a part of it is because Americans don't understand the true reason why the United States is there. When the president is asked about it, he has said things before like, I'm not thinking about Americans' financial situations. He means, and he said, when I am negotiating Iran to not have a nuclear weapon. But obviously the impact has been higher oil prices and higher gasoline prices. We've been maintaining across the United States above $4 a gallon in the past few weeks.
Anne-Marie, thank you so much for joining. Always appreciate it. That's Bloomberg's Anne-Marie Horder. Coming up, Lori Heinel of State Street, the global CIO, will be joining the show following Treasury's yields climbing back to levels that they were nearly at before Scott Bessent's shock Treasury intervention. This is Open Interest. Treasury Secretary Scott Bessent's bond buyback announcement continues to reverberate through markets, with analysts warning his plan risks being a short-time circuit breaker at best. Bond yields now climbing back just 2 basis points away from the level that they were before his announcement. Joining us now is Lori Heinel, Global Chief Investment Officer at State Street Investment Management. Lori, great to see you. Thank you so much for coming in.
Yeah.
So at best, this has kind of been noted as a very short-term fix. At worst, you have people like JP Morgan saying that this risks credibility, having the Treasury step in the way they do. How are you interpreting yesterday's announcement?
Well, first of all, it's just a drop in the bucket against the upward pressure that we see on rates, at least in the short term. Certainly, we've got concerns about the deficits, and that's just aggravated the situation. You also have looming inflationary pressures, which obviously puts upward pressure on bonds. And then you have massive issuance, not just by the Treasury, but by the hyperscalers and the other debt markets. So we think that this is really not something that's going to change the trajectory in the short term.
I mean, what even is the attractiveness of the long end of the curve at this moment? Because you have seen a lot of price insensitive buyers back out of the market, the Fed being an obvious one, and then other official government entities too, foreign entities, have also backed off of buying treasuries.
Well, look, you have to put it in context. It wasn't that long ago that we were talking about the fact that treasuries had zero yield.
True.
And so there was really no impetus for broader investors to have an interest. But now when you have interest rates at 4 or 5, maybe even higher, suddenly it becomes a bit more compelling from an asset allocation perspective. So we have seen institutional investors as well as individual retail investors taking advantage of the yield levels to actually deliver some kind of return in the portfolio.
So, other side effects that we've seen from this is dollar weakens, and it's more or less holding there. Gold also got a big boost from this too. If the Treasury move isn't enduring, does that mean gold's move isn't enduring as well?
Well, look, there are lots of reasons to think that gold has higher to go from here. First and foremost, as you mentioned earlier, some of the buyers, like the central banks, have actually been pivoting into gold, and so there's demand there. You have natural demand for gold through improving consumer postures globally, people wanting to buy, gold jewelry, things of that nature. And then there is this sort of overhang about the dollar, fiscal profligacy, debasement, some of those things we think give support to gold as well.
So all of this, part of the reason, so deficit's a very clear reason why bond yields have been moving higher. The other is just the AI issuance in the corporate bond markets. And I wonder what you think of supply. If there is indeed a crowding out effect happening, maybe on the Treasury market or maybe even non-AI related bonds too.
Look, all of this is related. If you have a situation where the U.S. government is looking to raise more capital, they're running deficits, so you have the same time when other borrowers are looking to raise capital, increasing their outstanding debt, then investors have choices. And so if there's incremental yield to some of these investment grade hyperscalers or investment grade financial services companies or other investment grade bonds, obviously that's going to be a trade-off that investors will make.
What do the conversations look like with clients about bond portfolios and maybe how much more active they need to be? Because obviously just at an index level, the benchmarks contain much more tech than they ever did before.
Well, much more tech, but also much more treasuries.
True.
So we've been talking about this for many years as well, this idea that if you just buy the ag, if you will, you're getting a very concentrated bet on one thing. And so we've been talking about the need to really diversify your fixed income portfolio, including things like mortgage-backed securities, other investment grade, even private credit, things that actually give you incremental return and perhaps have a different sort of reaction function, if you will, to the rates dynamic.
Isn't private credit, though, also increasingly AI exposed as well?
It certainly has been and will be and probably forevermore. But it's much more broad-based than that. And I think the key element there is that you have investment-grade companies that are going into the private markets for reasons other than the fact that they just can't get capital.
So when you have Treasury yields drifting higher like they are, and yesterday just serves as a momentary blip, is there a point, Lori, where you get concerned for overall risk markets? The S&P has been declining, gained yesterday, fell for 3 days, but still pretty rich, still pretty close to all-time highs. Are you surprised that higher yields haven't weighed on risk assets more?
Well, look, the good news here is that earnings continue to be very compelling, and it's not just a monolithic story anymore. You've seen more broadening out, and you look across all the S&P sectors, for example, they've actually generated pretty compelling earnings growth over the last couple of quarters. So there's a period at which we're in this la-la land in a way, where even though rates are going higher, they're not high enough to choke off any kind of investment, as we're seeing with the massive issuance. They're also not high enough to offset that growth, but valuations are concerning. And I think the other dynamic here is that those sectors that are priced for perfection are potentially vulnerable.
Okay, Lori, stick with us. We have the opening bell to get through first. That's Lori Heinel of State Street. And a check on your markets ahead of that opening bell. We are declining, down about 0.5% for the NASDAQ as it underperforms. The S&P just slightly less than that. It doesn't get the benefit of a bond market rally this morning as 10-year yields move higher by 5 basis points alongside oil that's trading above $93 a barrel. On the other side of this break, your opening bell. Let's get your trading day started. You are watching Open Interest. I'm Dani Burger. Matt Miller is still off on paternity leave. And we are looking at a market that sinks after yesterday's rebound. I should note that the NASDAQ did fall yesterday, but the S&P gained. Down 0.4, down 0.5. The Dow Jones also down as bond yields peak higher after yesterday's rally, which helped risk assets not doing the same today. This is something you don't see a lot. The same kind of company and same story ringing both bells. Both of them are defense tech IPOs. We have Lintris down at the New York Stock Exchange. They're IPOing. They do more AI defense tech. Down at the NASDAQ, you have First Breach. Again, another defense tech IPO, except not tech, I should say. They're more sort of ammunitions, full metal jackets, those kinds of things that they produce. But again, 2 IPOs in defense tech, and you can guess why. It's a hot sector. The U.S. needs to rebuild munitions. Probably a good time to be going public. In other stock stories, Walmart shares are falling more than 7% this morning. They reported sales, a rare miss of expectations. Comparable sales rose 2.6% last quarter. That is the slowest in 6 years. I also want to show you what Meta and Microsoft are doing this morning, because sources told Bloomberg that Meta has become one of the biggest customers, or rather, one of the biggest customers of Microsoft in their AI offering. They've spent hundreds of millions of dollars a year to access AI models through the Azure cloud services. Both of those stocks slightly weaker, though we are looking at big tech selling off alongside Treasury. So that seems to be the bigger impact there. We are back with State Street Global Chief Investment Officer Lori Heinel. Lori, we were just talking about earnings looking more strong, broad-based. But you have someone like a Walmart talking about a weaker consumer, especially at the lower end, and things like gasoline weighing on them. They have some weird one-offs, things around pharmacy and drug prices. But I wonder what you've gleaned from the consumer this earnings season.
Yeah, so first and foremost, we've been concerned about the consumer for a while. Certainly the employment numbers still are holding in okay, although we saw a pretty tough print last time. We've seen fracturing, particularly at the lower end of the consumer. The savings are somewhat exhausted, wage growth not keeping pace with inflation. So we think that there is vulnerability, and that's one of the areas that we've been watching closely.
Watching it or avoiding it too? When does that line get crossed?
Well, certainly from a sector allocation perspective, we've been reducing our weight to consumer, both durable as well as discretionary on this dynamic, as well as seeing other opportunities. Things like healthcare, financials look pretty attractive still.
Healthcare, yesterday's story was so remarkable with Moderna developing a vaccine which could essentially stop reoccurrence of a type of cancer of melanoma. The advancements in healthcare have been looking quite remarkable. Then you add AI into it.
Right.
How much about healthcare right now is just this is a defensive industry, it's safety in a time where AI is really tumultuous versus fundamental earnings growth from these companies?
Well, there are a couple things. First of all, the valuations were relatively attractive, and so you get a little bit of boost from that. Then you get a little bit of an upward surprise, and obviously yesterday's announcement was very compelling across the whole sector. But I think that is the story about AI. And one of the things that we've been talking to clients about for years now is that, yes, in the initial phases, it is about the hyperscalers. It is about the infrastructure, the data centers. But ultimately, it's going to be about how that translates into real-world applications, and healthcare is a great example of that.
How do you treat an index that at the broader level, though, is being subject to the volatility of the hyperscalers? One day they're up, one day they're down. Chip stocks do well, chip stocks sink. Yeah. What do you do in a market like that where the leadership looks incredibly choppy?
Well, I think it is a broadening out question, right? And so earlier this year when we did our 2026 outlook, one of the things we talked about was that broadening out, that you pivot away from those high flying sectors into other real world economy sectors, value stocks, small cap stocks, because they are likely to actually outperform if they have any impulse and they actually see their earnings start to improve.
But how do you square that away with what we started out talking with the consumer?
Yeah.
How many of those are vulnerable to any sort of cyclical downturn, especially in the consumer?
Well, some of them are more so than others. I mean, certainly we've been still very cautious on things like real estate, and mortgage rates remain a real impediment to that sector in particular. And certainly if you think about the broader consumer impulse, it is the K-shaped economy. So you have to look for those places where it's a little bit more impervious.
So you're still modestly overweight U.S. equities. What does it take to get the American equity index to continue to have gains at the pace we've seen this year?
Well, maybe we won't have gains at the pace we're seeing this year, because we're still having pretty incredible gains, but we still do think that it's the most attractive house on the block, if you will. It does benefit from a number of things. Obviously, U.S. growth has been quite resilient and continues to outpace many other parts of the world. You have the gearing towards AI and some of these thematics, which are outsized growth engines. And we still have a consumer that, while, as I mentioned before, is fracturing, it's still relatively healthy and still powering that economy.
How much of that is a, shall I say, optimistic but muted optimism? I feel like I'm not hearing full-throated bull from you, Lori.
We're not. And in fact, if anything, we've been paring back our overweight to equities generally globally, partly because of concerns about inflation, partly because of concerns about growth slowing, geopolitical risk. There are all manner of reasons to be uncomfortable, but we still retain a slight overweight.
How are you thinking about geopolitical risk at the moment? We're back at $93 a barrel on Brent crude this morning.
Look, it's really tenuous. I think at some point the markets have just sort of looked through that, because it's hard to really predict what's going to happen this week, tomorrow, next week. And at the levels of oil prices right now, at some point it sort of exhausts itself in terms of the transmission mechanism into consumer prices.
I also feel like probably as humans, we also don't want to think of the worst. So that's also hard to factor in. When you're looking at things, though, to hedge more broadly, we've had a few people on this week come on and say, yes, the U.S. looks strong, but Europe, maybe it'll help you hedge some of your AI exposure because there's less in there. I know you also like emerging markets, too. How are you thinking about exposure outside the U.S., even though you prefer American risk the most?
Yeah, to that point, we've actually preferred emerging markets versus the other developed markets. We just think that Europe in particular is still going to be much more vulnerable to anything that's happening in the Gulf. And oh, by the way, while valuations are relatively attractive, as you say, the growth rate's just not there. So we see emerging markets as the place where there is that kind of good trade-off. And oh, by the way, some of those markets are highly geared to the AI complex as well.
It's true. And a lot of this, again, gets back to the build-out that we're seeing in AI and how important that is. When you're looking beyond the hyperscalers, for the companies that are benefiting from AI, we're talking about healthcare, how do you discern what is AI theater and what is actual progress and more sustainable margin compression, for example, from these companies that are being derived from AI. Is that actually showing up in the earnings at this point?
Well, it is in some ways. I mean, even when we talk about the retailers, you can see some differentiation there. And our job when we look at fundamentally what's driving individual companies is to discern those companies that are making good investment in technology and other capital expenditures and those that aren't. And so we've been looking for a while at markers like, do we see improved productivity? Do we see, a changing structure in how they're deploying capital? Do we see innovation? And those are the kinds of things that draw us to a company.
We're going to have to end it there, but it's been so great to have you in studio.
Yeah, no, thank you very much for having me.
Thank you for stopping by. That's State Street's Lori Heinel. Let's get a check on your markets. We're about 7 minutes into your trading day thus far, and we are down on the index, only 0.2%, or just less than that. We are looking at a breadth that is decisively down. More than 300 stocks are moving to the downside. Walmart is having a really, really tough run of it. I'm going to start in the down column because that's the worst performer. Walmart down 7.5%. It's taking off 4 points from the S&P. At one point, it was down 8.7%. For the biggest decline since July of 2022. A lot of the big cap tech stocks are also down this morning as Treasury yields push higher. Moderna, that comes back down to earth after it experienced those huge gains. It's down 17%, but again, it had a giant rally yesterday. A lot of short covering in that name. The up column, you have Nvidia, Broadcom, Micron, so a lot of the AI type names. Exxon. Energy has been trading really well, reaching new highs. So let me show you what the various sectors are doing, because energy is at the top. We're back at $93 a barrel for Brent crude. That's followed by Infotech, largely helped by Nvidia this morning. On the downside, staples, discretionary, consumer sectors are doing really poorly because of that Walmart miss. Their weakest comparable sales growth in about 6 years. Coming up, we're going to talk more about that and the weaker growth over at Walmart. We're going to dig into the results with Greg Melich of Evercore. That's coming up next. You're watching Open Interest and not looking at the principal room. You're looking at Nora. Hey, Nora, what's up? Just want to point out we will have coming up an interview with Bess Freedman of Brown Brothers Real Estate. Anyway, in the meantime, Nora, let's get to you. I know you're looking at some top calls this morning.
I am. First up, Bank of America upgrading Etsy to buy and setting a street target high of $105 in their price target. The firm says Etsy's growth is starting to look more long-term as the company's strategy under its new CEO holds up better than expected, shares to the upside by about 1.9%. Next up, Morgan Stanley upgrading Merck to overweight and boosting its price target after its melanoma vaccine with Moderna delivered positive results. The firm now expects Merck's revenue to stay flat instead of falling 5%. You will see shares, though, to the downside, defying that move, down about 1.8%. And finally, TJ Maxx and Marshalls had a weak quarter. Bernstein saying sales are soft, and Jefferies questioning why growth is slowing so sharply. Meanwhile, eMarketer says Burlington and Ross are adding to the pressure. Shares of TJX down by about 2%. Those are your top calls. Dani?
Nora, thank you very much. And let's stay with retail. Walmart posting its slowest U.S. sales growth in over 6 years due to pricing pressure on its pharmacy business. Let's get more on Walmart earnings with Greg Melich, Evercore ISI Senior Managing Director. He has an outperform rating and a $140 price target on the stock. Greg, great to see you. How much of this is just messiness in the quarter from things changing and pricing changing for their healthcare offering versus something that told us about weakness of the consumer, especially the lower end consumer?
Yeah, no, great questions. So the quarter was definitely a disappointment with the comp coming in at 2.6. We were thinking it would be around 3 to 3.5. And there was an extra 30 bips of deceleration from the Fair Pricing Act implementation. But that's going to stick around. So I think the reaction today is basically Walmart saying, you know what, we're going to go back to doing what we do best, which is if we have tariff rebate money, we're going to use that to offset a rising energy cost, but also really invest in price and to help reaccelerate that traffic, which still nice at up 1.5% in the quarter, but last quarter traffic had been up 3%. So I think to help consumers out here, I think Walmart is doing what they do best, which is lean into price.
and they gain market share, and perhaps part of it is because of price, but we are seeing their competitors like Kroger and Target also looking at reducing prices. Greg, at what point does their ability to capture market share start to lessen because competitors are adopting the same strategy of value?
Well, it's a competitive market, and I think that's one of the things that we're seeing. We're calling it the food fight into the back half this year. But consumers have cumulative inflation over the last 3 or 4 years does weigh on consumers, and so one of the ways to keep them in the game is to do extra rollbacks. Walmart's up to 11,000 rollbacks. Target yesterday talked about reducing prices on 10,000 items. So you're right. If it comes into a food fight of basically who has the scale and who has the ability to invest to help reduce prices for consumers, I think Walmart is in that good competitive position. For them, I'd say the important thing was confirmation that a lot of the new businesses are growing north of 20%, in some cases even up to 40% if you look at advertising. And those are the things that will give them profit growth and outsized profit growth to basically do this while keeping the P&L intact. And that's what a lot of competitors don't necessarily have. So that's why I think Walmart will come out of this in a good position. But it does take some time to get that traffic back when you start this reinvestment.
In this food fight, how does Amazon complicate things in their push into groceries?
Well, Amazon has certainly been pushing in consumables. They've talked about 150 billion of grocery consumable sales. It's not so much food as it is consumables. Look at that. I think you have a situation now where Amazon and Walmart combine to about 20% of U.S. retail sales, and we think both of them have plenty of room to grow that to 25 or 30% over the next 5 years. And they're both doing it with membership models, and I think that's where Walmart still has it can compete effectively with Amazon, but they're going to make sure that whatever share Amazon takes out of grocery and retail isn't coming out of them. And likewise, I think Amazon is going to make sure whatever Walmart's able to do with growing Plus membership and getting into more middle and upper income households going to them also for good value and convenience, they're going to make sure they don't lose out on that either.
Greg, it feels like you're describing an environment for Walmart that is still very strong but more competitive. And I wonder, given all of that, do you think that the reaction today looks overblown to you to see Walmart have its worst day since 2022? Is this just kind of an optics problem at the moment, considering the numbers that they put up, but underneath the surface, there's still fundamental growth to be had?
I love that conclusion, or I think that's fair. I mean, I'm not going to sugarcoat it. I mean, comps decelerated and even traffic slowed 150 bips sequentially. I think part of that is last quarter, basically retail sales were stronger back in March and April when we had the benefit of all the tax cuts and the refunds from last year. But what you are seeing this quarter is a deceleration. I mean, Target had a good quarter, but they also had a deceleration of 150 basis points from their last quarter. So I think you are seeing a slower consumer environment. And I think Walmart has all the tools to compete effectively in that. And, expectations, I think, got high with where the multiple had gotten earlier this year. And now the reality is, as we settle down, I think they can still grow numbers, still grow their earnings at probably half the rate of sales as we go into next year. I think ultimately that's why people will end up finding a nice bottom in Walmart here.
Greg,
it's still a good company with growth.
There was this narrative, though, around Walmart in quarters past that weakening consumer sentiment might be good for them because you have more middle and upper middle income consumers trading down and shopping at Walmart. Were they absent this quarter? Did that phenomenon not take effect?
I think that effect is still there. I think what's shifted a little bit, and this happens a lot of times with volatile energy prices, and it could speak to why maybe we'll see some of the other retailers still reporting, a lot of the dollar stores, et cetera, because their stores are further away from people. So sometimes when gasoline prices go up, they'll consolidate trips. That could be an excuse or a reason, a perfectly good explanation, or just because it might cost you $5 to fill up your car with gasoline to drive to the Walmart. Maybe you go to the dollar store where you can just walk there. So when we've seen this in the past, when we get volatile energy prices, that can be a consumer reaction, at least in the near term, while they remain volatile.
Greg, really appreciate your time this morning. Thank you so much for joining us. That's Greg Melich of Evercore ISI. Coming up on the show, Deere's results point to a potential rebound next year for farm machinery. We'll have those results coming up. This is Open Interest. You're watching Open Interest. Let's get a check on your equity market 20 minutes into your trading day. The NASDAQ falling again today. It is its fifth consecutive day of declines. The S&P, though, that was able to move higher yesterday, but NASDAQ still leading the losses. Treasury yields moving back higher yet again. Let's see how close they are. We're now about 3 basis points away from the level that they were before the Treasury made their announcement of increasing buybacks on the long end at 523. They got to 526. And before that, they closed at their highest level since 2007. So we're still quite elevated here, but that's weighing on risk sentiment as a whole. As is this, Brent crude not helping things out. It's up by 2% as the president says that he will wage economic warfare against Iran to try to bring them in. Meta, Microsoft, we learned that Meta is one of Microsoft's biggest customers when it comes to their AI offering. Again, what is Meta doing in-house that they're now needing to move to Microsoft? Alibaba reports earnings. It's kind of the same story we've heard from the U.S. big tech players. Underwhelming is what analysts said about it, and they're spending a lot on CapEx, so that gets markets nervous. Coty, they are the beauty conglomerate. Poor set of earnings from them. Shares fall 6.6%. They own Hailey Bieber's brand. Look, it's a really crowded market for celebrity beauty. I think there's too many out there. Finally, Walmart. That is also a disappointment. Their weakest growth in about 6 months, and then 6 years rather. And Deere, those are perking up nearly 4%. They raised the lower end of their annual profit outlook. There's a stabilizing agricultural sector, and that's pointing to a rebound next year for farm machinery. Joining us for more is Bloomberg intelligence analyst Chris Ciolino. Chris, it's been a difficult time for agriculture. What did we see in Deere's results that look so optimistic?
Yeah, it was a solid quarter and really good execution. And as you point out, it's still a very challenging ag market as we continue to bounce along the trough here. The 3Q results were better on both the top line and margins, really across all three businesses. I'd even highlight some notable strength in small ag as well as construction. They did also benefit from a sizable tariff refund, which was a meaningful contributor to the beat. But I think the most important thing coming out of this release was management's constructive commentary on their early order programs, which appears to suggest that we should see improved earnings next year. We'll need a little more detail on the call in terms of the magnitude of those increases and what the trajectory of a recovery may look like.
And in pointing to those early order program trends, Chris, we also heard the CEO say that they think this is going to mark a bottom of the current ag cycle. Is that what you're seeing too?
Yeah, that's our view. I mean, this year we're looking at large ag volumes kind of near the lowest level in more than 4 decades. What we're seeing now in terms of month to month, it seems like things are soft but relatively stable. So we think downside risk from here is somewhat limited. And we would anticipate, even in a flat retail market next year, just the fact that we're not going to be underproducing retail demand to bring down inventories, that should be enough to generate some significant operating leverage in the model.
Chris, for a lot of machinery companies, we've seen them getting more geared towards AI. How does Deere fare in this world? Are they adopting a lot of AI technologies? Are we going to start talking about Deere as an AI company one day?
Yes and yes. It's one of the biggest areas of investment, precision technology, precision farming, doing more with less. It continues to be a significant focus, not only here in North America, but down in Brazil. There's significant potential down there just given the sheer size of their farms and some of the large crop production down there.
How should we be thinking about that spending, though? The cost of it, the cost of compute, has been coming down. It's been weighing as these companies lay on this new cost layer in the form of AI. How is Deere handling that?
Yeah, so typically what we've seen from Deere is a lot of the new precision technologies and precision products. You're looking at typically like a 2-year payback window to really kind of entice farmers to make some of these investments because, the pricing and the upfront cost has been significant. They're still tinkering with the pricing model and the whole pay per acre and subscription model. But you're typically looking at a 2-year payback to try to get farmers, to increase adoption of these precision farming solutions.
Hey, Chris, we're going to have to leave it there. Thank you so much for joining us. That's Chris Ciolino of Bloomberg Intelligence. The latest on Deere as those shares rally more than 4.5%. Coming up in the next hour, Kara Murphy of Kestra Investment Management on market headwinds lurking beneath the surface. And Brown Harris Stevens CEO Bess Freedman joins us as home sales slide to the weakest level since the start of the year. All of that coming up in hour 2 of Open Interest. We are 30 minutes into your trading day. Welcome to Bloomberg Open Interest. I'm Dani Burger. Matt Miller is off. We are back to losses for the S&P and a fifth straight day of losses for the NASDAQ. Coming up, Walmart earnings disappoint, sending a warning signal across the retail sector. President Trump threatens Iran with economic warfare after failing to reach a deal. And the 30-year rally unravels as Bessent's bid to tame yields faces a skeptical market. San Francisco Fed President Mary Daly weighed in.
At the long end, it is typically driven by structural factors like fiscal sustainability, geopolitical rebalancing, the massive AI investment for this industrial renaissance, which people are very excited about. And those factors are driving this. The thing that I look at specifically is this is happening across the globe. It's not just a U.S. phenomena, it's a global phenomena. And it doesn't give us a lot of signal about what we should do in the policy adjustments or the policy calibration for the Fed. And there, we look at the short end more than the longer end.
Let's discuss all of this with Bloomberg macro strategist Michael Ball. Mike, we've seen Treasury yields now climb back up just a few basis points away from the level that they were before yesterday morning's announcement. A lot of ink, digital or otherwise, has been spilled over the idea that this is short term, but that's extremely short term. The fact that this lasted basically 24 hours, the effect of the Treasury.
Yeah, it's a little backfiring, right? Because it has a sense of panic almost, especially following the yen intervention. And the idea would be we get to Jackson Hole, wars can reset some sort of expectations there with Fed credibility. But this was supposed to be a lifeline that would have, bought some time, and now it's not. Now, of course, we had a lot of positioning in the steepener that got squeezed yesterday, which exacerbated the price move. And now maybe you're seeing people trying to re-enter that trade. Or generally, like we're saying from Mary Daly here, there's a global story now with higher yields across for not only, let's keep an eye. Oil's back up. We have no end in sight to AI. Financing, and obviously we all know what's going on with the deficit, and the forever war now in Iran, which is sort of being the new narrative around it, is not helping with that as well.
I saw a meme on X somewhere of, when Treasury Secretary Scott Bessent is at the podium and he has that piece of paper that says buy yen. Yeah. Someone's scratched that out and has written buy U.S. bonds. I wonder if we also look at Japan in a different light now. The fact that they used euros, that they have the FEMA facility, everything basically to Japan to say defend your currency, not through selling U.S. treasuries. Right. Should we relook at that and say this was an operation not to help the Japanese, but rather to help this American bond market?
No, 100%. I think that's the primary motivation. Again, remember the 333s. Bessent always has this goal of getting 10s down to 3, which would help mortgage rates and basically loosen up sort of households that are stuck kind of in unable to move. That would help the labor market. There's all these kind of thoughts he had when he first came out. None of that has actually come to fruition because, of course, the reality of the world came down on him much harder. But to your point, I think what we're seeing from Bessent is a guy who's trying to run a hedge fund still a little bit with all these little micro tweaks, and the actual structural problems are much larger. And as we know, the administration and Congress themselves haven't really made any noise about how we're going to, address deficits. It's gotten worse, if anything.
But does this just represent sort of a capitulation, I guess, that you do have a Treasury Department that has now decided yields are bad enough and they're kind of launching a full-out assault trying to bring them in?
Yeah, again, just like the yen, we'll draw a line here with the 30-year at 5.3%, which is a very dangerous thing because as it breaks, then you get more of a panic versus this linear grind we had for good fundamental reasons. Remember, growth was picking up. So for a while, their real rates rising wasn't necessarily a negative as they were coinciding with positive earnings. So it wasn't risk off. Now we have to worry about that sort of flipping and that correlation breaking down.
Michael, thank you so much for joining. Always great to have you on. That's Bloomberg's Michael Ball. Let's continue the conversation. Joining us now is Kestra Investment Management Chief Investment Officer, Kara Murphy. Kara, for you, what does this mean to you? Are 30-year yields all of a sudden more, 30 years all of a sudden more attractive because of the buybacks coming from the Treasury?
I think this is, as your previous guest suggested, a kind of micro move. And I think part of the reason why the market kind of moved past it so quickly is simply because it is really small, right? The Treasury market is just tweaking around the edges. I think the other piece to this story is that the Treasury is saying that we're going to support the long end of the curve, but sacrifice the short end of the curve. And interestingly, like the bulk of their borrowings are still very much on the short end of the curve. So as there's more focus on this like rising level of government debt, this actually makes it harder and more expensive for the US government to refresh that debt. So it becomes a very tricky game.
It's a great point, and not only are they maybe sacrificing the front end curve, but also the dollar. The dollar weakened dramatically after this, and it's basically unchanged this morning. Is that a concern too? Because you also weaken a dollar at the same time that you're trying to rein in sticky inflation. Of course, a weaker dollar has the effect of making external purchases more expensive, thus importing more inflation.
Yeah, and I think this is a taste of kind of a longer term trend where we've had a very strong dollar for a number of years, and there are pluses and minuses for US consumers and investors to that. It's not all good or all bad. But I think we should expect that the dollar is not going to have that same sort of hegemonic status that it has in the past. And our own foreign policy is sort of like pushing some of our, previous allies to get rid of some of those American assets. So I think this is going to unfold for quite some time.
Let's combine this with what we're seeing in equity markets, Kara. Yes, they're off this morning. They gained yesterday. The up and down, though, masks what is an index that's trading very close to all-time highs. It is printing something like a 30% earnings gain so far this quarter. If we're printing something like that number, does that mean that equity markets are impervious to higher bond yields?
I think as long as the corporate earnings power remains as strong as we think it is, then the market can continue to march higher, right? So, I mean, the earnings rates that we're seeing right now, the corporate profit margins that we're seeing right now are absolutely amazing. It's hard to overstate. The worry is that, it's a very much a show me market. If there's any hint that that earnings growth is not coming through, then I think you're going to start to see investors head for the hills. So right now, the momentum is very much in favor of U.S. equities. We're also seeing some strong earnings revisions outside of the U.S. as well. So I think we're seeing a kind of like strong resurgence, partly driven by AI, but it is a show me market.
Just to that exact point, Kara, I'm so happy you said that because I feel like Walmart is a really good poster child for a show me market. It's down almost 9%. It's on track for its worst day since May 2022. Is that the case with Walmart? Just expectations were really high? Or is it something more troubling? Maybe not even for Walmart itself, but to have the weakest growth in some time, does that suggest something a little bit more dangerous around the consumer as a whole?
Well, I was going to suggest, I think the comments that we got this morning play into this narrative, too, about the K-shaped economy. We have oil that's increasing now above $90 and doesn't seem like there's a really clear path below. And as we think about those higher oil costs, for the U.S. economy in general, they're not all that negative, but they are quite negative for the low-end consumer. And that's where Walmart and some of their competitors play. So I think we're seeing the very real effects of those headwinds. And then not to mention the fact that we have, a negative real wage growth because of higher inflation. This is a lot of pressure that we're seeing on the low-end consumer.
Then for this equity market, is there complacency? Are we looking past some of these risks at the moment, Kara, or does it just all come back, I guess, to broader-based earnings?
I think there is some complacency. As we said earlier, there is real, genuine earnings growth. But as we look at, for instance, like fund manager positioning, cash levels are very low, equity levels are quite high, put-call ratios are quite low. So VIX is very, very low. So there are a lot of signs that, investors have gotten potentially a little bit complacent. And you throw on top of that, second half of August is often seasonally a little weak period. So again, these things tend to be fairly short-lived, but it does make me a little concerned.
Kara, just to wrap it up, one of the other big heady conversations happening now is kind of the only conversation these days is AI. And I wonder how you're thinking about exposure when it comes to the ecosystem. There's been a real chop whether the hyperscalers do well, whether it's the chip, whether it's memory, whether it's those that are adopting AI. Where in the ecosystem do you want exposure to, especially just given the churn that we've seen?
it's been really interesting. I call this like AI is growing up, right? Just as our kids are all going back to school, we're seeing AI become, a real full-fledged type of business and technology that has implications throughout the economy and the market. And we've seen over the last year or so, the market start to turn its gaze from the very initial firms who are focused on building out these AI capabilities to kind of some of the more downstream ones. And I think this is very healthy. So whether it's like power generation or industrials or storage, this is like the power of AI that's kind of proliferating out. Now, this will continue, but I think as like a long-term investor, what you really want to think about are what are the applications of AI, right? And this is where it gets massive. As you have all of these companies who are experimenting, trying to figure out how to become more efficient, grow faster, and innovative, I think these are like the real exciting things that we're going to start to see percolate throughout the economy and throughout the market.
Kara, really fantastic to have you on. That was excellent. Kestra's Kara Murphy, thank you so much for your time. Let's get a check on your equity markets. We are about 40 minutes into your trading day. The S&P continues to fall about 1/3 of 1%. The Nasdaq down 0.5%. The S&P trades at 7683 this morning. Your 30-year yield, that trades at 524, just about 2 basis points away from the level we were before we got the announcement from the Treasury on expanded buybacks on the long end of the curve. That is weighing on the overall market. Adding to the selling in Treasuries this morning, it's higher oil prices. They are up 2.5% for Brent crude, trading just under $94 a barrel. Let's look at some of the individual movers this morning. On our radar this morning with that is Nora Melinda. Hey, Nora.
Hey, Dani. Let's start with retail. Walmart shares lower by more than 8% and on track for their biggest one-day drop since 2022. Now, this comes after a rare quarterly sales miss where sales growth was at its slowest in more than 6 years. Lower drug prices also weighing on those results. Next up, another big AI spending story. Sources telling Bloomberg Meta has become one of Microsoft's biggest AI customers, spending hundreds of millions of dollars a year to access AI models through Azure cloud services. Meta shares you do see to the upside a touch, and Microsoft falling by about 1.3%. Now, sticking with tech, Alibaba's profit plunging more than 75%. This comes as the company intends to spend more and more money on AI while consumers in China are actually pulling back. You are seeing ADRs down by about 3.6% this morning. Those are your morning movers. Dani?
Nora, thank you so much. Coming up on the show, an exclusive interview with CFTC Chairman Michael Selig following a high-profile crypto meeting at the White House that, along with lower bond yields, got crypto rallying. That's coming up next. This is Open Interest. Let's get you some high-interest stories to look at what's making headlines around the world. Supermicro says an independent investigation found no evidence that its senior leaders knew about an alleged scheme to get restricted products into the wrong hands. The probe also found no direct sales to restricted parties and no issues with the company's past financial statements. Supermicro fired several employees and is tightening its export controls. Virtu Financial is exploring a sale of its agency brokerage and tech division for as much as $4 billion. That potential deal would free up capital for Virtu to invest its core market-making business and expand into other asset classes. Talks are early, and Virtu could ultimately keep the unit, but a sale would let them compete more aggressively with rivals like Citadel and Jane Street. And Max Verstappen, staying with Red Bull through 2030, the four-time F1 champion says that he seriously considered retiring rather than switching teams, but renewed confidence in the sport's direction convinced him to extend the deal. The contract would make Verstappen and Red Bull the longest-running driver-team pairing in F1 history. And just a note on that, everyone loves showing these videos of Verstappen with the manager of Toto Wolff of Mercedes together. Maybe he would go to Mercedes. I guess that's not happening. That sorts that. Elsewhere, crypto and prediction market executives met with White House officials yesterday in part to discuss the passage of the Clarity Act. It's a regulatory crypto bill. In attendance was Michael Selig, chairman and Commodities Futures Trading Commissioner. Bloomberg's Tyler Kendall had the exclusive interview.
We're very optimistic that we're going to get clear rules of the road for crypto asset market structure on the books, and this vote is critical. We've got to get the Democrats to come along with us. They have really obstructed. We want their support. This should be bipartisan. The bill passed the House in a bipartisan fashion. We've got this bill in the Senate. It's very similar. We want to get it across the line. It needs to be a fair bill. a bill that isn't targeting the president or anybody else. It should be neutral and apply to everybody in the same way. We're really excited to get this bill across the line. CFTC stands ready to implement upon the passage of the bill.
Just to quickly follow up on that, was there any discussion yesterday about any updated ethics provisions related to the bill?
Well, the ethics provision is under negotiation. We're looking forward to seeing a fair ethics provision that's not targeting the president or anybody else, as I said.
If clarity stalls or fails to pass, the CFTC has signaled that it's prepared to unilaterally dial up oversight. What would that look like? What sort of rulemaking are you prepared to take in that scenario?
The CFTC has a lot of authority, and we're not afraid to use that authority. The president has promised market structure for the crypto industry, and that's what we're going to do, whether we have a bill or not. But we're optimistic the bill is going to set the standard. We really want the United States to lead, and having legislation, clear law on the books is the most surefire way to lock in crypto market structure. And so that's what we're focused on today.
But for my clarity, if clarity doesn't pass, you're still going to pursue regulation related to this?
Well, absolutely. It's really important that we have market structure. We can do that through rules. We can do that through laws. The CFTC has a lot of authority under its existing statutes, as do other agencies. And if we have to utilize that authority to create rules without the supporting legislation, we'll do it. But of course, legislation is the priority. That's what we want to see. America needs clear rules on the books. We'll use rules if we have to, but we're going to focus on the law today.
Right, because in theory, or not in theory, in reality, the Clarity Act is there to codify this into law. So I'm just wondering how you're thinking about the future here to ensure that if there's a Democratic CFTC under a different administration, it wouldn't unwind all the work that you'd be doing.
We're, of course, going to look to the bipartisan efforts on the Hill no matter what. If we have legislation, we'll implement that legislation. If we don't have legislation, we'll, of course, utilize that existing work that's been developed on the Hill and utilize our existing authorities and do what we can to set rules of the road for crypto. But the bill is really the priority. The bill has to get passed.
That was the CFTC Chairman Michael Selig speaking with Bloomberg Washington correspondent Tyler Kendall. And Tyler joins us now. Tyler, that did have the effect of increasing optimism in the crypto market, Bitcoin trading above $71,000 this morning. What was your takeaway from that conversation?
Well, Dani, at this point, it's very clear that the administration wants to get the Clarity Act over the finish line. We saw yesterday President Trump holding this event side by side with the CFTC chair in a bid to try to get some momentum here, because the truth is, at the moment, at least publicly, the votes aren't there. And people who were in that meeting yesterday behind closed doors do tell me that there seemed to be an acknowledgement that more work needs to get done. That's in part why I asked about whether there's been any movement around the negotiations for a potential changing in the ethics provision in this bill to try to address some of the Democrats' concerns, because at the end of the day, this is legislation that needs those 60 votes to pass, which means that all Republicans have to get on board, which isn't a done deal yet, and that you need at least 8 Democrats to get on board, too. The president is expected to call holdouts related to this. I also had a conversation with the CEO of Robinhood, Vlad Tenev, who told me that his team is also actively calling lawmakers on the Hill to try to get this done, because, Dani, at this point, the vote in the Senate is scheduled for September 15th. We're going to have to see how it goes, because I'll point out Washington right now is on recess. It's actually pretty quiet around here, so at least to our knowledge, those conversations aren't happening here in D.C. They're only happening on the phone.
When it comes to trying to get holdouts to agree to this bill, especially on the Democratic side, Tyler, how much is this complicated by the extensive reporting that's been done within Bloomberg and elsewhere just on the president's own fortunes, his family is tied up in the crypto markets?
Administration sources, Dani, have told me that they definitely felt that added fuel to the fire in terms of the president's own holdings here. And that's really when we started to see some of the updates around what those negotiations were ultimately going to look like, perhaps escalate, if you will, because Democrats really started to use those headlines to push for additional changes. There had been this provision that was negotiated and approved by the White House, but would ultimately give the Department of Justice authority over those ethics concerns. Democrats would like to see that instead go over to state attorneys general amid their alleged concerns about independence in this process. There are other concerns, though, with this bill as well, including from the banking industry when it comes to yield on stablecoin. There's different factors here that have to ultimately sort of, come out in the process to get the legislation over the finish line. The administration wants it to happen. But Dani, perhaps the biggest headline from this is that regardless of what happens, the CFTC says that they are going to move forward and regulate the industry, even if they don't have that codified into law.
I was also really interested in your conversation about AI compute futures. Silicon Data, it's a company we've had on this show trying to launch or will be launching compute futures with the CME. They've announced plans to start doing that. How is the administration, how are regulators rather thinking about this new world?
They seemed really optimistic about it. We know that the CFTC had opened the comment period in order to try to get regulatory scrutiny in order so that these AI compute futures can ultimately go live. We'll see what happens here. Michael Selig telling me directly that this is something that will play keenly into the administration's goal to put forward innovation in this space. I also had the chance to ask the CEO of the Intercontinental Exchange, Jeff Sprecher, about this as well. And he really felt that this is the best way for lenders and these big tech companies related to the AI space to hedge their costs. We talk a lot about all the different factions related to this industry, and this is definitely going to be one that at least the CFTC seemed that we should expect more headlines about. He told me in the next 90 to 120 days.
Tyler, great work over there. Thank you for bringing us that conversation. That's Bloomberg's Tyler Kendall in Washington. Still ahead on the show, Brown Harris Stevens CEO Bess Freedman joins to discuss the slowdown in the housing market and maybe where the strength remains in luxury. This is Bloomberg Open Interest. Nearly an hour into your trading day, and the losses are holding for this overall index. Tech is underperforming. It is down 0.4%. It's not necessarily any single catalyst that's causing that underperformance, but perhaps just higher yields this morning, undoing some of the work of the Treasury yesterday. Longer duration assets, especially with all the AI infrastructure spending from the hyperscalers. So that falls. S&P down 0.3%. It gained yesterday. NASDAQ 5 days running. It's been posting losses. Here's what the 30-year yield is doing. It's now at 5.22, off the worst of what we've seen this morning, somewhere around 4 basis points away from the levels it was before the announcement. Brent crude still higher, quickly whipping through companies. Meta spending a lot on Microsoft AI. Alibaba, they reported earnings. Underwhelming was the general consensus, and a lot of AI capex. Coty, again, the beauty supplier, another set of earnings that was poor. Walmart, earnings poor, concerned about the results that they've posted. Now down 9.3%, on track for its worst day since at least 2022. And Deere, a beat for them, suggesting, at least the CEO said, that we've reached a bottom in the agriculture cycle. Coming up, Bess Freedman from Brown Harris Stevens on whether luxury real estate is bucking the housing slump and can continue to do so. That's after this break. We have seen some tough data for the U.S. housing sector this week. Data from the National Association of Realtors showed that home sales fell in July to their weakest level since the start of the year. That comes as 30-year mortgage rates hover near one-year highs. The Treasury obviously trying to fix that yesterday to not much success. The housing slowdown is also weighing on the outlooks from some of the earnings we've had from Lowe's to Home Depot. Let's discuss with Brown Harris Stevens CEO Bess Freedman. Bess, great to see you.
So nice to see you.
And we should note for our entire audience, of those that are not familiar with your business, that you are operating in the more luxury side of the business. How insulated has that been?
You know, we do more discretionary sales and rentals. You know, it's not insulated because we do work with first-time home buyers as well. But yes, we're known for the luxury, but, you know, 30% of our deals are under $1 million. So, you know, but we do have the records for the high end of the market. But we work with everyone, rentals, studios, you name it.
So where are you seeing pronounced pockets of both strength and weakness? How I guess divergent have different localities been?
I think the housing market is it's like a K housing market. The high end is really doing well. June and July were amazing. People are buying. It's great. And then you see this whole affordability crisis in the United States overall. There's a lack of inventory. You know, rates are higher, as you just mentioned. Inflation. You know, people can't afford to pay for things. They can't buy their first-time home. Access to housing is now becoming an issue because of these private listings. So now people can't get in to see what's available. I mean, it's just all of those things don't bode well for people.
What's up with that? Is that just like a uniquely New York thing?
No.
Since you don't have this, that's happening everywhere.
It's
Why
all over
that?
the country. Well, it's being investigated by the House committee right now. Elizabeth Warren spoke about about it. She's looking into it. The president of the NAACP, Derek Johnson, called it out as having concerns for fair housing. There's a company, it's Compass, and they have 80% market share in New York and large market shares all over the country. And they have this private network where you shouldn't have to know somebody to see the inventory. And so that's being investigated. It's being looked into. The AG is looking into it. And so that's another concern in an environment where already we don't have enough inventory, right? And so hopefully, that will get worked out. Just another little piece to add,
By the way, another fun little piece to add is the pied-à-terre tax, and of course, allowing that to go through. How has that been with your clients? Well, what does the reality look like on the ground for people who are confronting this?
We have had some non-residents say they want to sell, and they're selling their homes because they don't want to pay this surcharge. And to be clear, it is not a one and done. It is an annual surcharge that you're going to have to pay. And also, a lot of residents receive these notices who are full-time residents here. So they're saying, guilty until proven resident. Like, why should the burden be on us? We are full-time residents of New York City. So it's too soon to say what will happen. But remember, real estate transaction taxes bring in about $2.2 billion of revenue for the city. So if human behavior changes and wealthy people stop buying here, then the money they think they're going to make from this sort of political tax, a pied-à-terre tax, will go down. And therefore, it may even just be a wash. So it feels like a punitive tax. I feel like there were better ways to get revenue for the city than doing something like this.
Is it also increasingly hurt by the optics of it to have the mayor specifically single out people? Does that increase some of the damage?
It does, because, look, we want successful people to be a part of New York City. They contribute so much. And when did success become such a bad thing? Like, why are we saying that's bad? It's a great thing that people accomplish things and make money and give back. Like, I don't understand this divisive sort of good, bad, landlord, tenant, rich, poor. It's nuanced. We should all work together. That's what this country is about.
Not to wildly generalize and go off on a tangent, but it also feels like a generational thing.
Yeah.
It feels like people who are just graduating, maybe feeling a little bit disillusioned, are the ones that are really sort of embracing that mindset. But it's also people who are benefiting from a wealth transfer that's happening right now with silver
100%.
tsunami. So what is kind of the dividing line of younger generations who are finding themselves with the benefit of their baby boomer parents' money, but also sort of pushing back on this idea of, success and capitalism and that sort of thing?
I think they don't get it. They don't understand it. My daughter's friend, the day that the mayor got elected and, he won and she was so excited, she came in and she's like, we won. And I was like, what did you win? Your parents pay your rent. Like, what? It's sort of this... it's sort of this luxury values. They can afford to think that way. Of course we want free buses. They don't understand that you have to pay for things. It's like the rent freeze. Do you think that's helping the city? Rents are at an all-time high right now. So we need to have plans that are collaborative versus dividing and sort of punishing people.
It's interesting because just from personal experience, I'm a renter and my rent is going up a significant amount. And I know my landlord also has rent-controlled buildings too. And my brain immediately went there. He's trying to offset that. How is it? I mean, maybe it's impossible to discern, but some of the climb in rentals in New York, does it seem tied to some of the inability on these controlled housing units to be able to raise the prices?
Yeah, I mean, so the rent stabilized units, that freeze is just going to impact smaller landlords who have a few units and are not going to be able to afford it, and they're not going to be able to maintain those units. So you're really squeezing those landlords. But the high-end market has already been, going up, up, up. And last year they passed this legislation, the FAIR Act, where legislators thought that if they took the onus off of tenants to pay the brokerage fees, that would help rents go down. It's done the opposite. And we told them that when we testified at City Hall. And so now landlords are just putting that into the rent to make the rents higher, and therefore that's all gone up. Got to listen to each other a little bit, right?
What are you hearing from politicians this midterm? A lot of the conversation has been around things like data centers and affordability. Has housing been a big topic of conversation? Are you worried at kind of the horseshoe of politics where both sides are sounding more populist on these types of issues?
Yeah, I mean, it's concerning. I don't think there's enough of a discussion about it, about affordability and building and upzoning, things like City of Yes, which were very helpful to New York that will get more units in the city. I think people don't want to talk about it because because they don't know how to solve for it. And it shouldn't be a political topic. Housing should be something we care about for everyone, right? So I don't know how we solve for that myself. I would love to be a part of those conversations, come up with ideas, but we have to, business community, politicians, we all have to work together.
By the way, I would also love for you to be part of that conversation. What would the ideas be? Is it things like removing red tape? What are the things that
those
could
sorts
really
of
bring...
things like zoning, like being more flexible in zoning, giving incentives to developers so that they build. We want more building in New York City, but they're not going to do it and lose money. They have to have tax incentives to do so. A little common sense, you know.
I feel like we could have this conversation for an hour.
I could talk to you forever.
I'm so sad we're out of time. You'll have to come back soon.
I would love to.
Thank you so much,
Thank you for
Bess.
having me.
That's the Brown Harris Stevens CEO, Bess Freedman. Let's get a check on your markets this morning. We are more than an hour now into your trading day. The S&P falls by 1/3%. The Nasdaq down 0.5%. Overall benchmarks are weighed down by the fact 10-year yields are climbing higher. We're off of the highest levels that we've seen this morning. We're up about 4 basis points. We're at 468.62 for your 10-year yield. Brent crude, that's also adding to pressure, up 1.7% at $93 a barrel. Let's look at some of the other movers on our radar this morning. With that is Nora. Hey, Nora.
Hey, Dani, a few stocks in focus for you. First up, Deere raising the low end of its profit guide, and a sign that things may finally be starting to settle down in agriculture. The company says orders are looking better and there's less used equipment just sitting around. Shares are up just about 7% this morning. Now on the flip side, Advanced Auto is plunging double digits and heading for its worst day in more than 3 years. That's after sales fell short of expectations on Wall Street. And Wall Street's not sugarcoating it. Citi calling the results, quote, disappointing. And Truist saying the quarter was tougher than expected. Shares down by 22%. Now finally over to beauty. Coty reporting another drop in sales. And it's not ready to give an outlook for the full year just yet. The company calling this a, quote, transition year. Shares falling by about 9.9%. Those are your morning movers. Dani?
Nora, thank you so much. Coming up on the show, Meta has quietly emerged as one of Microsoft's biggest AI customers. We're going to have more on that story next. You're watching Bloomberg Open Interest. Meta has become one of Microsoft's biggest customers, using trillions of tokens a week on Microsoft's Azure cloud service. Joining us to discuss this further is Mandeep Singh, Bloomberg Intelligence Global Head of Tech Research. Mandeep, this is a company where a conversation started to be had. Might they become a neocloud? Might Meta start to rent out some of their compute? How do we interpret the fact that they're spending so much on using Microsoft services?
I mean, right now, I feel Meta is at a point where they really believe they can still train their model and get it to frontier level, the Muse Spark they released. And this use of Microsoft Cloud is likely, them benchmarking their model against what OpenAI has. And we know OpenAI is the most used model on Microsoft Azure. But Microsoft Azure hosts all types of models. So if you are a model developer like Meta is, then that's the best way to benchmark your model. So that will be my guess here in terms of what they're trying to do. Look, you're right. I think their fallback option is to use their own infrastructure for renting out, like SpaceX has done with Google and Anthropic. But Mark Zuckerberg was very clear on the earnings call. He feels that's the last option. He would rather train their model, release as API, and drive API consumption as opposed to renting compute.
Is there any sense to the timeline, both in the executives and this market, the patience they're willing to extend for them to get this done? Because they've already fallen behind in this race.
They have, and when you compare the 2Q results, Meta didn't really raise their CapEx in a big way, whereas everyone else said, oh, because of the higher memory prices, we are raising our CapEx. Meta was the only one that kind of raised their lower end, but pretty much reaffirmed their CapEx guide. So to my mind, they feel the pressure, but at the same time, I mean, it's coming from, Mark Zuckerberg himself. He believes they can still get to that frontier capability, and they are focused on coding agent and some of the established cases, yeah.
Can they do it if they're not spending as much as everyone else? Is that kind of a double-edged sword that maybe the market's not as upset with you if you're not spending as much, but you need to spend even more in order to get to that level?
I don't think, I mean, look, when you're spending about $140-50 billion, that's a ton of money to train your model. So it's, in their case, it's not a question of...
They're not spending peanuts, yeah.
Yeah, and they have hired a lot of talent, really. They paid up for that. So it's just a question of can they train their models and bring it to frontier level? Because we know open weight models have caught up. Meta was the original open weight model company. They've changed kind of course on that. So strategically, they really need to figure out if they can be at the frontier or not. And that will dictate whether they'll get into the cloud rental business.
I mean, we spent a lot of time talking about what this means for Meta. What about on the Microsoft side of things? Is this really positive news for them to have one of their essentially competitors spending money at Microsoft, or maybe bad because they ultimately might pivot away and they lose this source of business?
I don't think Microsoft considers Meta as a competitor simply because they've, like lent Bing search engine to them in the past. So for Microsoft, it's all about cloud usage. They don't care who the customer is, and they want a lot of customers as opposed to being concentrated to OpenAI or just one customer. So if from their perspective, it's a cloud usage that counts, and I think Meta using is one of their bigger customers now.
Mandeep, I realize we're going to spend, I believe, literally every single day next week talking about Nvidia.
Yeah.
But I would love, just before we're in the panic zone, to get your thoughts. We're going to hear from them on Wednesday, just how big of an event this earnings is going to be.
I mean, look, the numbers are getting so big now that it makes you wonder, can Nvidia keep growing at that pace? And now that they are in the financing business, the private equity, the $500 billion deal that they announced with different players, it just feels like the stakes are getting bigger and bigger. Google did that deal with Marvell. So a lot of moving parts. But so far, Nvidia has shown that they can continue to execute, and they really have created that ecosystem. So to me, it's really about that ecosystem and how they feel they can keep their customers, which, again, it's pretty concentrated if you look at their customer base. But what that exposure is going to look like.
I saw this analysis, and whoever came up with this will have to forgive me because I can't remember exactly who it came from. But the idea went, something like Nvidia has become the central bank of AI, that they are, in effect, keeping the cost of capital really low for the ecosystem and allowing this spending and allowing this growth to happen. I wonder what you think of this idea, that part of what their aim is in this ecosystem, again, is just to make things like buying chips affordable for companies in this world.
Yeah, and especially because the numbers are getting so big, so they are acting as the backstop. But what they're saying is we are not the only provider of money or capital to, OpenAI. They have to raise their own money. So from their perspective, they want to maintain that pace of growth. They don't want a digestion period where things slow down because people are waiting for ROI. And right now, this is all upfront investment. But they believe that companies will start generating revenue that they can the likes of OpenAI and Anthropic can pay up on their own over time.
I hope you have a relaxing weekend coming ahead for you, because I think next week will be anything but. Yeah. Mandeep, thank you so much. That's Mandeep Singh, Bloomberg Intelligence Global Head of Tech Research. Coming up, Iran's foreign minister responds to President Trump's threat of economic warfare. We're going to bring you the details next. This is Open Interest. President Trump has declared what he calls economic warfare against Iran. He took to Truth Social announcing, quote, the most crushing economic operation ever. Let's get the latest with Bloomberg's Kayleigh Lyons, co-host of Balance of Power. Kayleigh, in this context, what does economic warfare mean?
Well, economic warfare likely means that other countries aside from the U.S. would need to be involved. And the president says that those countries know who they are. In this post on Truth Social, he talked about how any country that is facilitating the smuggling of Iranian oil, be it banks or airports or the like, needs to rein it in, essentially. He said oil smuggling, swap lines, cash transfers, exchange houses, ship registries, front companies, it all needs to stop now, saying that he is announcing any country that allows its financial institutions or government entities to support a type of lifeline to Iran will face tremendous economic consequences. This, of course, Dani, puts a huge spotlight on China in particular, the single biggest buyer of Iran's oil. And China is pushing back against this today, saying that further sanctions and pressure will not work, that there has to be a diplomatic outcome to this conflict between the U.S. and Iran. But it also puts perhaps added pressure to the visit that Xi Jinping is planning to make here in Washington next month. Well, he'll be meeting with President Trump at the White House on September 24th. So this could be an issue of real contention if the president is serious about bringing other countries to put economic pressure on Iran in a more serious way. All that said, the UAE did perhaps give this administration a boost when it cut economic ties with Iran just yesterday. But there is also a massive question, Dani, as to whether or not further economic pressure ultimately would be successful, even if you had China playing along and secondary sanctions took effect on buyers of Iranian crude. Iran has been under sanction for nearly half a century. It's been decades, and it's been able to withstand them to this point. So there is a question as to whether or not further economic pressure is something that the regime is going to cave to.
Kayleigh, what about just the pressure of a midterms and that increasing sanctions could also increase the price of oil?
Well, that is a very real consideration. It's also a consideration when we consider the sanctions package that targets Russia that the Senate passed just before the recess. Some of the critics of that legislation, including Senator Rand Paul, who I spoke with, said because it gives the president power to tariff countries that buy Russian energy products, that it could just further exacerbate inflation. He said it could be an economic catastrophe. So that is a consideration. But if he also is looking at the consistent issue with getting energy out of the Strait of Hormuz, which is having an impact on gasoline prices, which remain above $4 on average per gallon across the country, that too creates a political problem ahead of the midterm. So it's a rock and a hard place, clearly, that the president finds himself in here. What is clear, Dani, is when he is looking for an out, it does seem that this administration and the president himself wants to look at the economic levers rather than the military kinetic options that may be on the table, especially due to the depletion of key munitions for the U.S. military.
And has this president, Kayleigh, he put on Truth Social that he's not talking with the Iranians. Does it seem like diplomacy is now out of the question?
Well, it depends on who you ask, because Jared Kushner, his peace envoy, Dani, has said that there is ongoing conversations happening with Iran, directly counter to what the president said, in which there are no ongoing conversations, in his words, and none scheduled. It may become a definition issue of what exactly you classify as talks. Perhaps not formal, direct conversations between the U.S. and Iran are happening, but there could still be messages being passed back and forth through intermediaries. So it's frankly not clear. What we do know is here in Washington, the talks that the administration seems most presently focused on are trade talks between the U.S. and Canada ahead of a deadline that, of course, has moved to Friday to try to get a deal and avert 50% tariffs going into place on billions of dollars of Canadian goods.
Where does it seem where we are in those talks, Kayleigh, and what the U.S. might propose to Canada?
Well, Bloomberg has been reporting out some of the details as to what this agreement might look like, including potentially the halving of tariffs on Canadian steel and aluminum exports, cutting that in half from 50 to 25%, at least for some things. There is a lot of nuance here, according to Bloomberg's reporting, and officials that are being spoken to about this, that perhaps derivatives of products that include things like steel and aluminum may face different rates. There's also the question of rates that will be put in place on autos. That could be cut from 25 to 15%. For non-U.S. made parts is our understanding. So it does indicate that there is some forward momentum. We are hearing positive things from both the U.S. administration and from Canadian Prime Minister Mark Carney as well, who talked about securing favorable terms for Canada and some of its most critical sectors. And I would note, Dani, that at 12:15 p.m. Eastern time here in Washington, so just about an hour and a half from now, we are expecting that the U.S. Trade Representative Jameson Greer is going to be meeting with some of his Canadian counterparts to try to hammer things out further.
Well, all the more excited then to listen to Balance of Power today. Kayleigh, thank you so much. Bloomberg's Kayleigh Lyons. Balance of Power kicks off at 1 p.m. A check on your markets this morning. The S&P down about 0.25%. The dollar is unchanged, but that's perhaps not good news because it dropped yesterday. Following that move higher in bond yields, this concern, are we sacrificing the dollar with the Treasury's move? But bond yields, even though the dollar isn't undoing a lot of its action, Treasuries are 30-year yields up 4 basis points off the worst of the losses that we've seen so far today. But we are about 3 basis points away from being at the level that we were before the Treasury's announcement. Gold, that also takes a step back, but had huge gains yesterday. We're trading at $4,500.66. I just want to point out the NASDAQ also leading the losses this morning. That's down 0.5%. Coming up tomorrow on Open Interest, Stephanie Guild of Robinhood and Melich of Allspring, and Critical Metals CEO Tony Sage. That's tomorrow. Enjoy the rest of your Thursday. This has been Open Interest.